disclaimer under Section 107 of the Copyright Act 1976, allowance is made for fair use purposes such as criticism, comment, news reporting, teaching, scholarship, education, and research. Fair use as a use permitted it by the copyright statute that might otherwise be infringing. Hello everybody, welcome to my channel. I am Afro. Please, as you enter the room, hit the thumbs up and subscribe to my channel. Today's video, we're going to talk about Vanguard, the $8 trillion finance empire. So, without further ado, we're going to get into this video and we're going to see what's going on here, okay? Here we go.
It's the dawn of a new century. After 2 decades of economic boom, the American finance industry is more prosperous than ever. Leading this explosive growth is a new type of company that just 20 years ago was totally unimaginable. Vanguard, the nation's first and largest index fund. The captain of Vanguard is a man with unlimited ambition, who through sheer force of will built a financial empire.
He created an institution that was pro-customer. I just loved it.
He democratized investing for individuals, which was a huge contribution in the mutual fund space.
Jack Bogle is pretty much like a T-Rex in terms of what Vanguard is. You don't see too many folks anywhere in the world that manage that much money.
Did he say he's more like a T-Rex? If y'all know what a T-Rex is, that's this dinosaur, right? The most dangerous dinosaur, the dominant dinosaur. So by him using that term, we already know this man is powerful. Okay? Powerful. I just had to say that. Anyways, back to the video.
John Bogle is born into a wealthy family. His father was a decorated pilot during World War I, and now has a high-paying job for the legendary company American Can. The Roaring Twenties is a decade of unprecedented prosperity. During the Roaring Twenties, there was this sense that you can't lose. People everywhere seemed to get wealthier.
The stock market in the 1920s became a retail market in a way it had never been before. When the people heard that their neighbor had doubled his money in the market and then doubled it again, you started to feel like a fool if you didn't do it yourself.
But just months after Bogle's birth, the US stock market collapses. Bogle's father, William Yates Bogle, loses his job and all of his inheritance money. He tries to recoup, but lacks the tangible skill and resourcefulness to survive. He never recovers and becomes addicted to alcohol.
I gotta say this, right? Things didn't work out for him. And when you're used to money, you will go insane if you don't have that same money, right? And this is a thing that a lot of rich people do. This is not a white thing. This is a every rich person thing, okay? They tend to lose their mind. They don't know how to cope, and they turn to alcohol or drugs or both. Or they kill themselves. One out of three or all. Okay? Just wanted to say that. All right, let's get back into the video.
With his father buried in alcoholism, Bogle and his 2 brothers are forced to grow up quickly and start working early.
I think his father was not a great achiever. He didn't achieve a lot and had trouble holding down a job. And I think that also probably sparked Bogle to want to make something of himself.
From a young age, Bogle develops a strong work ethic and a meticulous habit of saving every penny he earns. This is a defining period of time for John Bogle. His harsh childhood taught him to be frugal and self-reliant. These qualities will become the guiding principles for his business in later life. The young Bogle knows there's only one way to a better life. He needs to get himself into a great college. To do that, he has to become the hardest working student in his high school. By 1947, his hard work pays off. He graduates from Blair Academy as a class salutatorian and earns a full scholarship to one of the nation's best universities, Princeton. Jeb Bogle has become accustomed to using brute force to get ahead. He aims to become the top student at Princeton, and he plans to accomplish that by working harder than anyone. But he quickly realizes that Princeton is not the same as his high school. Bogle finds out that Princeton was full of students that not only just worked as hard, but also seemed to perform better in classes. For the first 2 years, Bogle's grades consistently failed to measure up, often with him ending the semester with C's and C minuses. By his junior year in college, Bogle realizes his only way to graduate from Princeton as a winner is through writing an exceptional thesis.
At a time when December of 1949, and when one was thinking about one's senior thesis, I was going to graduate in 1951. You can't start too early at all. Since I was a contrarian, I wanted to write a thesis on a subject that nobody had ever written on before.
Bogle bets his academic success on a thesis, but the problem is he has no idea what to write about. To make his thesis stand out, he must write something unique. As an economics major, Bogle soon becomes fixated on a new type of investment company, the mutual funds.
I opened Fortune magazine. The industry was described as tiny but contentious. And no one's ever written on this before that I knew of. There may have been something later, but I have never seen it. And I picked on the spot in the library that topic for my thesis, the open-end investment company or the mutual fund.
In 1951, the mutual fund industry is still in its infancy, managing barely $2 billion in assets. It's an insignificant portion of the finance industry. So a mutual fund is not just one company. It typically consists of two companies, one serving as the management company, and the other is the actual fund in the form of a partnership. So if you invest in a mutual fund, you're legally joining a limited partnership. And that partnership will hire the management company to manage your money. And the management company will invest your money in different financial assets like stocks and bonds. But for most Americans who barely came out of the Great Depression alive just a decade prior, the safest investment is still savings in the bank. But Bogle realizes that the mutual fund industry is on the precipice of a revolution. Bogle believes that in the long run, more American investors will see the value of having access to a diversified portfolio.
Well, one thing that I would say about college, it seems like it's fun. You know, the way that they put it on TV and stuff like that, when they make movies and all that, they make it seem like it's fun, but it really isn't. And I think with him, he had probably got that same notion that it would be easier, it would be fun, you know, it won't be that much of a hard work. And then he found out that it was every bit of hard work. He couldn't keep up, you know, so he came up with a different way of doing things, which was kind of clever. But so he's the top person of the financial empire, but he hires people, another company, to manage his money, I guess. So it's pretty much two companies in one, I figure. I don't know. I'm gonna finish listening, but that was clever for him to do that. But let's get back into the video. We'll see.
One that the mutual fund industry provides. Bogle's thesis is a success. His analysis and insights on the mutual fund industry sets him apart. He graduates from Princeton magna cum laude. His outstanding thesis paper also has an unexpected consequence. It also catches the attention of a prominent mutual fund. Walter Morgan is the founder and chairman of the Wellington Fund, the fifth largest mutual fund in the country, worth over $150 million in 1951.
The fifth largest financial fund. I'm about to get confused. It's too much large money going on here, and I'm about to get confused. So I ain't gonna lie to y'all. It's something that's kind of like got me a little Then I don't know. I got to finish watching. Let's get back into it, y'all. But I'm telling you right now, I'm a little confused here. But let's see. Let's go.
"35 years earlier, Walter Morgan was a stock trader. After losing virtually everything from betting on oil stocks, Morgan became convinced that it was impossible to make money from speculation. He turned himself into a defensive stock investor and created a so-called balanced portfolio.
Less volatile funds tend to work well for investors. And so, of course, if you, instead of having just stocks, if you combine it with bonds, say in a 60-40 mix, the classic mix, it's less volatile and it's easier on investors. It's just less drama, and that works well for investors.
He then founded his company to help others do the same by avoiding the temptation of speculation and focusing on steady growth and preservation of capital above everything else. By the early 1950s, his fund, Wellington, becomes a pillar in the mutual fund industry. After reading Bogle's college thesis, Morgan immediately recognizes the talent and the potential of John Bogle and hires him to be his executive assistant.
Well, the most valuable lesson, I suppose, was taught to me by Walter Morgan, my great mentor at Wellington. It was all about balance, balance, balance. You know, they'd been through a tumultuous period in the 30s, and even halfway through the 40s, and it worked just fine, a balanced idea. He also drummed into me the fact the crowd was always wrong. If everybody wanted something, that's what you did not want.
But Bogle's timing to join Wellington couldn't be worse. By 1958, the bull market is in full swing, with Dow Jones almost doubling from 5 years prior. Many mutual fund companies are opening more funds to attract more investors. As a result, Wellington's balanced portfolio is falling out of favor, as the risk appetite of Americans has come back. But John Bogle sees this challenge as an opportunity to make a name for himself in the company. He devises a bold plan, one that his mentor might not approve of. Bogle wanted to start a new fund that contained only equities. He believed that a stock-only fund will attract investors as long as they stick to a conservative investment strategy. The Wellington Equity Fund is an instant success. In just 1 year, it grows from $33 million to having $44 million of assets under management. The fund's performance and popularity continue to grow for the coming decade. The success of the Wellington Equity Fund makes Bogle the designated successor to Walter Morgan. And by the time Morgan turns 67, he officially passes the reign to Jack Bogle. And at the age of 35, Bogle becomes the CEO of one of the largest mutual funds in the industry. But it's a mutual fund whose entire existence is now under threat. A war in the mutual fund industry is about to break out. Only this time, Bogle may be its first casualty. By the early 1960s, the spirit of speculation is back in what's become the go-go decade. Bogle may be the leader of Wellington, but as the competition heats up, the mutual fund starts to decline. During the bull market, when everyone was doing so well, all of a sudden, his Wellington fund started to look very boring and mediocre. And people didn't just want steady growth anymore. They wanted to make a fortune in the market. As more investors jump ship from Wellington, Bogle begins to worry. He knows if he doesn't do something fast, his company may go under.
Given
Bogle was mighty rich at what, 34, 35 years old? He did pretty well for himself. 35, 34 years old. But that's kind of money and that kind of company. Yeah. Wow. I just want to say that. Okay, back to the video.
the responsibility at age 35 to take over the Wellington Management Company because we were in deep, deep trouble. And Mr. Morgan said, do whatever it takes to fix it.
To save the company, Bogle needs to somehow make his Wellington fund attractive to investors again. And there's only one path forward. Wellington needs to merge with another fund. To save his company from becoming obsolete, Bogle tries to find a merger with a more established firm, like Franklin Templeton and Incorporated Investors. They reject Bogle's offer because they believe Wellington's overly conservative strategy will hinder their fund's performance. Unable to find a large mutual fund to merge with, Bogle is forced to search for smaller ones. And soon, a fund in Boston catches his attention. iVest is an aggressive mutual fund that has the best performance in the industry from 1960 to 1965. Even with just $17 million under management, it's one of the most sought-after funds in the industry. iVest was very akin to today's prop trading firms, using a lot of short-term strategies and technical analysis. So during a bull market, it's very hard to judge if the success of such a firm is due to luck or skill. But Bogle
Okay, so he went looking for a partnership with the larger firms, but they declined. And I guess I can see why, because if you have a larger company and you're messing with someone that was part of something that was declining, you have more to lose as a larger company. But if you find, so then he went, seeking out the smaller companies. Well, of course, the smaller companies will take a chance on him because the smaller you are, the more you don't have that much to lose. You understand? So you're going to take that chance in working with someone that that, it does work, but I guess you have to, take that chance to grow with it. Again, when you're working with something smaller, you really don't have that much to lose, so why not take that risk? As opposed to if you're a larger company, you have everything to lose. Okay, so I understand that. So let's see how this turns out. Back to the video, y'all.
Bogle believes by merging with iVest, Wellington will be able to expand the business and attract more investors. After months of consolidation, a new company is born. While it will carry the name as Wellington Management Company, the partners of iVest will now have 40% ownership. Many consider giving iVest so much control a huge risk factor, but Bogle believes it's a sign of sincerity. Finally, Wellington is reborn, ready to take on its competitors and regain its market share. John Bogle is poised to continue leading the new company as CEO. But fate has a different plan. Weeks before the board of the new company announces Bogle to serve as the CEO, he suffers a massive heart attack. For a while, Bogle has lived under a heart condition called heart arrhythmia. He suffered multiple minor heart attacks since the age of 31. But none of them was as severe as this one. Bogle is hospitalized for 6 weeks. As a result, his future as the chief executive of Wellington is now on the line. Unsure if Bogle is fit to lead, the directors of Wellington are considering a new candidate. Only Bogle isn't the one who gives up easily. So to prove he was fit enough to work, Bogle went on the treadmill test. So a typical patient with his heart condition wouldn't last for more than 8 minutes. But Bogle, with his unbelievable willpower, lasted for more than 18 minutes. After demonstrating his health, Bogle is successfully elected as the CEO. For the next 5 years, the marriage between iVest and Wellington looks like the one made in heaven. iVest continued to gain popularity as it consistently beats its competitors. Leveraging iVest's popularity, Wellington opens more funds. By 1973, Wellington has 10 mutual funds under management, worth over $2.6 billion.
Now that's what you call a risk on someone. Here it is. You have someone that always, had multiple heart attacks, and has a history of him, gonna continue to get them, but yet still, he still was able to hold that seat as CEO. Wow. Now that's what you call taking a risk. Okay? That's called taking a risk. I don't know if I could have done that, but again, when you're working with smaller companies, pretty much, like they're just risk takers, So yeah, that was something though. All right, let's get back into the video.
While Bogle has little regard for his own net worth, he relishes the power and influence as the head of Wellington, which by now is the third largest mutual fund in the industry. But he fails to realize that it has all been an illusion. After a decade of speculative growth, the go-go era is coming to an end. Does that sound familiar? Consider today, since 2008, we've seen record bull markets, cash printing, and sky-high valuations. The result? Now the Federal Reserve is brutally stamping out inflation at the expense of your portfolio. Last year, out of the millions of people who invest with Vanguard 401k, a record number had no choice but to pull their money out. Now, more than half Americans who make 6 figures are living paycheck to paycheck. At least Goldman Sachs is clear about where the market is headed. Nowhere. The financial titans of today say the 60-40 portfolio of stocks and bonds is dead. Instead, they're pouring hundreds of millions into assets with low correlation to the stock market. One even appreciated over 130% the last time inflation soared this high. Contemporary art, helping grow and preserve billions in personal wealth. Of course, it's been impossible to access without deep pockets. That is, until now.
And didn't I say that in the beginning? When you have people that have money, when they go down to not having the same money as they had, they lose their mind. As you can just see, this lady, she was like this, she was about stressed out, and because now she's living check to check. See how that works? You're up high, you're on that high horse. But then reality sets in, because things can happen at any given moment to everybody. So nobody's exempt to losing what they had and becoming something that they didn't want to become, something that they never thought that they would become. But yes, you too. I just wanted to say that. All right, y'all, back into the video.
Masterworks is a New York-based billion-dollar startup that is changing the way people invest in art. As someone who has invested in shares of Basquiat painting through Masterworks, I'm grateful to be part of this journey along with so many others. In 2022, Masterworks had 9 exits, all of which were highly profitable. The last 3 returned 10, 13, and 35%, netting millions and millions to investors. It's exciting to see how quickly new offerings sell out. But I have a special link in the description that gives you priority access so that you don't have to wait in line.
The stock market plunged yesterday and stepped up trading. The Dow Jones Industrial Average registered its biggest loss for a day in almost 3 years. The index tumbled 18.29 points to finish the session at 909.69.
In a span of a year, Wellington's asset is down from $3 billion to $1.3 billion. Now it's all too clear. Bogle's decision to merge with iVest has been an utter failure. And then there's more bad news. As the industry conditions worsen, a rift between the board of directors widens. A fight soon breaks out, pitting Bogle against 4 Boston partners of iVest. Afraid Bogle may blame them for the fund's failure, the 4 partners decide to throw the first punch, secretly negotiating and gathering support from the board of directors and Wellington to fire Bogle. Remember, during the merger, the 4 partners were given 40% control of the company because Bogle thought they were reasonable people, and Bogle only had about 28% of voting power for himself. The board summons Bogle to inform him he needs to resign immediately.
And these guys had a real falling out. I think Bogle felt like he had betrayed his mentor and the company by sort of selling out and giving these other hotshot growth managers too much power in their partnership. They had effective voting control. So they got into a fight, fingers were pointed, and basically they fired Bogle.
But to their surprise, Bogle refuses to resign and threatens to do a proxy fight. Afraid that Bogle may win a proxy fight, the board decides to find a compromise. Instead of keeping Bogle as the CEO of the management company, Bogle now can keep a job as the president of the fund company. The job is a powerless position. It's an arrangement cooked up by the directors to silence Bogle's influence on the company. Since a mutual fund is typically managed by an external management company, the president of the fund typically doesn't do anything, much like the vice president of the United States. By 1974, Bogle is defeated and humiliated, kicked out from the company that was rightfully his. But even in a powerless position as the president of the fund, Bogle refuses to accept failure and immediately begins to look for ways for a comeback. What he does next will turn the mutual fund industry upside down. The 1970s is a decade of economic turbulence. The Vietnam War and the high government spending from a decade prior finally catch on, with inflation running highest it's ever been. John Bogle set out to build his Wellington Management Company the leader of the industry. But his decision to merge with iVest has proven to be a mistake. He's ousted as the CEO of Wellington Management and is installed as the president of the fund, a traditionally useless position designed to bury his influence. But Bogle is determined to find a way around the stranglehold of the management company. To do that, he will need to make a bold move. So legally, as the president of the Wellington Fund, Bogle is forbidden to make investment decisions. But since the fund is a partnership, Bogle is able to make business and administrative decisions.
He basically fought back and he found a sort of little leverage, which was that he was still the president of the mutual funds themselves. And so there's this wonky detail that the mutual funds are like shell companies, and the president of those funds actually has some control over who, they're like general contractors. They can decide who is doing what role. And so he used that leverage to basically dig in and fight with them.
While a mutual fund typically outsources the administrative works to the management company, Bogle makes a game-changing decision. He will no longer give the management company that business function anymore.
Boy, let me tell you something. When you are in these high-end companies, right, and there's money and all that involved, people fight dirty. They get deep down dirty with it. They're shiesty. They don't care who they stab in the back. None of that. They don't care who they rat on. It doesn't matter. At the end of the day, it's all about securing their money. And this is crazy, but it's reality. A lot of people do this, But money, man, will turn this world upside down. The more money you have, the more you want to keep or make more. You can't be losing out of money, because you would turn really, really evil to try to stay on top. Right? Right. All right, let's get back into the video.
Bogle internalizes the administrative functions, saving the fund millions of dollars in fees. What Bogle did was breaking the industry norm. A typical mutual fund doesn't do sales administration on its own. It typically pays an external management company to handle the tasks. To once again show his independence, he changes the name of the fund from Wellington to Vanguard. For the first time, Bogle believes his fund will be shareholder-focused. He calls it a mutualization.
It all lies in, I think, mutualization, trying to run mutual funds for their shareholders and not for their managers.
For the coming years, Vanguard, with his new structure, saves investors millions of dollars in fees, making Vanguard the most cost-friendly fund to invest in. John Bogle has managed to turn his humiliating failure into a success, but he's convinced a bigger opportunity awaits. He needs to completely cut Wellington Management out of the picture. The problem is, as a fund, Vanguard is legally forbidden to manage its own investment. It must hire an external management company like Wellington. Bogle is convinced that there's a way around this. After witnessing so many mutual funds underperforming the market for the long term, he started to question the value of such an effort. He questioned if it's even possible to beat the market. Bogle realizes in the long run, it is nearly impossible to outperform the market. And to serve his shareholders better, all he needs to do is to invest in every stock while keeping the cost low. It's a type of fund that was impossible to execute. Today we know it as an index fund.
So it's not that it's impossible to outperform, but what I've often said, it's like looking for a needle in a haystack, and at least the core of your portfolio ought to be invested in broad-based indices.
Influenced by Mulkill's research, Bogle believes the best path forward is to start an index fund. one that doesn't need to be managed. The simplicity of an index fund is brilliant, and Wall Street is never the same. Bogle launches the first index investment trust in 1976, designed to maximize shareholders' long-term profit. But what he doesn't know is whether people will buy it. But despite Bogle's good ideas, his Vanguard index fund struggles to take off. The press is calling it Bogle's folly. Anyone who invests in an index fund is doomed to have a mediocre result. The main criticism at the time was that by putting money in every company, in everything, it was very anti-capitalism. Bogle believes the only way to prove that his fund is better is by patiently waiting until the fund accumulates a good track record for the coming years. Just 7 years after the launch of the world's first index fund, American investors finally began to recognize the performance and the reliability of an index fund. And Vanguard's first index investment trust takes off, accumulating $100 million in assets by 1982.
And I remember in 1993, after looking at the underperformance of all these fund managers, finally kind of coming over to Bogle's attitude about the whole thing. Of course, it wasn't just that you could get into them and buy into the S&P 500. It was cheaper. Remember, you were paying 2%, 2.5% per year for active management at the time. Most of them were not outperforming. Suddenly, you could buy in for a fraction of that into the S&P 500. It was a simple insight, yet really revolutionary.
By 1988, Jack Bogle has accomplished the impossible, building the world's first index fund worth over $1 billion. His Vanguard Group, with its many low-cost funds, is the second largest mutual fund company in the industry. But for Bogle, it isn't enough. He wants to be number one. Occupying the top spot of the mutual fund industry is Fidelity, led by an aggressive and elusive man, Ned Johnson. And he isn't about to let Vanguard eat his lunch. By the early 1990s, Fidelity is the uncontested king of mutual funds. It was founded
That music had me scared. Like, that music sounded very, very intense and scary. I was scared. That's how you know it's some shit about to go down. Now let's see what that is, shall we? Let's continue.
Founded by Ed Johnson in 1930. Fidelity was one of the first mutual funds to deploy a diversified investment strategy. On top of that, Ed Johnson was a pioneer in hiring salespeople to sell mutual funds as if it's a product on the shelf. By the 1980s, it's the biggest mutual fund in the industry, with enough funds covering all sectors and asset classes. But out of all the funds, the only one that is capable of outperforming the market is the Magellan Fund. And it's all because of one man, Peter Lynch. From 1974 to 1990, under his management, Magellan Fund achieves a mind-boggling 29% annual return for more than a decade. The legendary performance made Fidelity the most popular investment company in the industry. With its growing control of the industry, who can possibly take on Fidelity now? Only one man would dare. Bogle's low-cost and better-performing index fund has disrupted the mutual fund industry and is also slowly eating away at Fidelity's market share. Fidelity believes the only way to beat Vanguard is by delivering performance better than index funds. To outperform Vanguard, Fidelity begins to expand to more areas, including starting an international bond fund. Ned Johnson demands the traders to do what it takes to beat the market and deliver above-average returns. Jack Bogle knows this is a recipe for disaster. All he has to do now is to wait for the giant to stumble. Bogle realized that given long enough time, most of the active management funds will underperform. He called it reverting to the mean. Even today, if you look at Berkshire Hathaway for the past 10 years, it didn't do any better than the market. And before long, Bogle's prediction comes true.
The fallout of higher United States interest rates affected Mexico, hurting many emerging market bond funds. Fidelity was hit harder than most.
After making a bet on Mexican debt, Fidelity's newly formed bond fund suffers a severe trading loss. As Fidelity crumbles, their failure demonstrates the validity and safety of Vanguard index funds. By 1995, Vanguard, with its low-cost index funds, has turned the entire finance industry upside down. Many of its competitors are rushing to catch on. With Vanguard in a better shape than ever before, Bogle decides the time has come for him to retire. For the past years, he's been grooming his executive assistant, Jack Brennan, to succeed him. In May 1995, Bogle officially passes the CEO title to Brennan, but he remains the chairman of the company. Brennan grew up in a banking family. His father was the CEO of Union Warren Savings Bank in Boston. As the head of the Vanguard Group, Brennan aims to leave his own mark and to prove to his father that he can outdo him. Brennan decides the only way forward is for Vanguard's assets to grow bigger. That means increasing spending on marketing and sales. There is just one problem. Bogle may never agree to this.
This industry became a total marketing business. It became an opportunistic business. It became a business creating expectations on past performance that could never possibly be duplicated in the future.
As far as Brennan is concerned, to pursue his plan without repercussion, there's just one solution. Bogle must resign as the chairman. Jack Bogle has helped put Brennan in the CEO position, but now his protege has turned on him.
John.
It is. It's always somebody gonna stab you in the back. His own protege done stabbed him in the back. Want him to step down. Is it surprising? No, because just like I said, with these big companies and stuff like that, when it's dealing with money, it's like every man for themselves, and people get to start stabbing each other in the back, and writing on each other, and just the shystiness, Money is a powerful tool, and these people would do anything to keep it going. But I digress. Let's get back into the video, shall we? Here we go.
C. Bogle was tough enough to survive a heart transplant, but now he cannot overcome the policies of the Vanguard Group, the mutual fund company he founded a quarter century ago.
At the age of 70, the chairman should retire by tradition. But Bogle wanted to make an exception for himself because, after all, he's the founder of the company. But Brennan and the board did not approve it, and they forced Bogle into retirement. In a span of 20 years, Bogle has built an unimaginable empire. While the company he founded will live on, and dominate the finance industry for decades to come. For Bogle, he is forced into retirement. With Bogle gone, Brennan expands the marketing and sales. But to truly leave a legacy, he needs to find something even bigger. By the late 1990s, a new segment of the finance industry is soaring: the ETFs. As the world enters the new millennium, Wall Street is undergoing a revolution. A new type of investment fund is growing at an unprecedented rate. They're called exchange-traded funds. It's a concept that has long been difficult to actualize, but now all the major Wall Street firms are staking their claims.
ETF stands for Exchange Traded Fund, a fund that trades on the exchange. So think of it as a mutual fund that is available to be purchased either in New York Stock Exchange or the NASDAQ market.
ETFs may be the trend, but one man believes that they are too volatile to benefit the average investor.
If I have a little bias against the ETF, market went down 300 points in the middle of the day, you got out, and then went up 300 points at the second half of the day. I mean, a lot of bouncing around is meaningless. But in the long run, that's a nuance, no difference whatsoever.
With the retirement of Bogle from Vanguard, and to compete with Fidelity, Jack Brennan is considering getting into the ETFs business.
Vanguard went very big into ETFs. It turned out to be a fantastic move. Vanguard itself quickly surpassed Fidelity, its big rival, because Fidelity was slower getting into the ETF business. And as a result of Vanguard's decision to sort of go against Jack's wishes, Vanguard is now a giant.
By 2019, Vanguard has almost $5 trillion in total assets. Many criticize that by being one of the biggest ETFs, Vanguard hurts its brand for being a long-term driven fund by contributing to the short-term speculations of the market. Although Bogle founded Vanguard, he remains critical of Vanguard during the later stage of his life.
Well, it's difficult. Let me be honest about it. It's difficult. The company is not particularly smitten with my directness and outspokenness in my books. And when someone says, well, I understand you disagree with Vanguard at that point, I say, absolutely not. I would never disagree with Vanguard. Vanguard disagrees with me. And it's their right.
On a crisp winter morning in 2019, the world mourns the loss of a legend. Jack Bogle is dead, succumbing to esophageal cancer.
Some more breaking news, this time sad news. An icon of the financial industry, John Bogle, the founder of Vanguard Group, dead at the age of 89.
Jack Bogle lived with honor and integrity. He defended his ideals until the last day. From a poor child struggling to survive during the Great Depression, Jack Bogle didn't stumble upon success. He fought for it. As a result, millions of American investors are better off.
Jack Bogle has probably done more for the American investor than any man in the country. Jack, there he is.
Well, Jack Bogle, if I'm saying his name correctly, was a very smart man. He fell, he got up. He fell, he got up. Fell, he got up. That's what you call determination. He wasn't going to quit. You know, he was determined to do what it was he set out to do, and he did that to the end. It's crazy how he had heart conditions all that time to now finding out that, you know, he also had cancer. You know, but they say he was like 89 years old. So he did live a long life, a long, rich life, you know, at that. So, but I don't know. I'm not really into this, you know, investing and all that stuff. It gets a little confusing to me sometimes, but however, I'm glad I watched this though, and now I know who John Fugel is, right? So, yeah, it just amazes me how he was just so determined, you know, and he made a lot of money in the process. So it's at the end, it's all well. You know, he lived his life, he lived his rich life. So, you know, shout out to him, may he rest in power. All right, y'all. So that concludes my video for today. So don't forget to like, subscribe to my channel, and leave me a comment. I like, you know, reading comments, you know, things like that, and listen to your ideas of what it is that you all have to say. So, being that said, everybody, please be safe out there, and be blessed. Peace.